The biggest financial challenge that most people will ever face is funding the final 20, 30, or even 40 years of their lives without a conventional paycheck. So you need every edge you can get. And one of those edges is being uncommonly astute about minimizing the tax drag on the wealth you'll need when the time comes. Today we address one of the least understood but most important principles of outsmarting the tax code. That principle is what we call tax allocation. That is, knowing precisely the most advantageous tax buckets into which to place the various building blocks of your portfolio. What do I mean by tax buckets? Here are the big three. 1. Taxable accounts, like your bank accounts or general brokerage accounts. 2. Tax-deferred accounts, like your 401k, IRA, or 403b. 3. Tax-free accounts, like your Roth IRA or the Roth component of your 401k. With these three buckets to choose from, where should you put your stocks, taxable bonds, tax-free municipal bonds, and the various ETFs and mutual funds that bundle them? Where should you put your historically fastest growing things and your slowest? What about the strategies with the highest turnover or the lowest? What about your most and least tax efficient? If you can master this, you'll gain an edge that most investors don't even know exists. We address all that and more right now on the Retirement Lifestyle Show.
Welcome to the Retirement Lifestyle Show. I'm your co-host, Roshan Loungani, here as always with Erik Olson and Adrian Nicholson. Adrian, how are you doing? How's the last week been for you?
I'm good. Everything's been good on my end. Just spent some time with some family and friends. Got to see some people I love and care about, so that's always a good way to start off the week. Erik, it's good to see you. Roshan, it's good to see you. How you guys been?
Good. Been a good week. I'm trying to think of anything interesting or different. We had my son's birthday. We went and saw Raya the Last Dragon. They're renting out movie theaters for COVID reasons, so we were able to get a theater and watch that. That was fun.
That's fantastic, man. And speaking of movies, I came back Saturday from Seattle, but before I left with my 5 and 3-year-old granddaughters, recorded a parody of Frozen that we called Heated.
Oh,
and so the powers were, rather than to freeze, were to turn things into deserts and to scorch people. So the little ones had a ton of fun with that.
That's awesome, Erik. We can maybe make it into like a small little commercial and insert into the podcast. That'd be pretty interesting.
Absolutely.
I would love to watch this movie, Heated. You've got to share that with us.
I will do that. 7 minutes. It's a short, but it's powerful.
What was your role?
Executive producer, director, writer, film, cinematographer, and a cameo as the counterpart of Hans, the evil fellow who's trying to horn his way in to be the king of Arendelle.
Oh, so you were the bad guy.
I was the bad guy.
Wow, that's that takes me back. That reminds me of a project I did in high school for my psychology class, and we were going over these different terminology and stuff. And you had to, for your project, you had to film a video, and the one that we got was narcolepsy, so we had to do an informational video about it and kind of turn it into a little bit of a movie. And we had to direct it, produce it, record it, and show it to the whole class. And it was a lot of fun. I think it's somewhere up on YouTube, so I gotta try and find it and take you back down memory lane. Yeah, that was a good memory I have about it. That was awesome.
All right, so we're gonna watch Adrian in narcolepsy and Erik in Heated.
Roshan, you got to have some type of content out there for us if we're gonna expose ourselves. Is there anything you used to do?
I cannot think of anything that's out there, thankfully.
Any basketball videos or anything like that?
If I could find it, I do have a video out there that was out there from years ago where I did hit a shot in overtime for the win. And before that, with the shot clock running down, I threw up a prayer from probably 10 feet beyond 3-point line that went in. Possibly my
Wow.
basketball greatest game of my career, possibly.
No kidding. Wow, that's an awesome one to have.
And definitely with that, there are other blooper reels out there, I'm sure, of me on the basketball court.
It's funny.
So, gentlemen, we've got a great topic today that we're going to talk about. And Erik, why don't you share the topic and tell us why it's important for everyone to take notes and think about doing this in their portfolio.
Yeah. So, listeners, I know you've all heard the term asset allocation at some point, which is essentially what kinds of investments in what proportions should make up your portfolio. For example, how much large cap stocks, small cap U.S., international, et cetera. But a much lesser known concept is the concept of tax allocation, because just in the same way as there are different kinds of asset classes, there are different kinds of tax classes. Specifically, we think about tax-deferred accounts, IRAs, 401ks, 403bs, and such, tax-free accounts, such as a Roth IRA or the Roth component of a 401k and some other alternatives. And then taxable accounts. That would be just general investment accounts that don't have the tax treatment of either of those two others, where short-term capital gains, long-term capital gains, interest and dividends, you're going to be paying taxes on along the way. Believe it or not, and that's what we're going to talk about today, it is not normally advantageous to be, what would I say, unobservant about how you position your assets with respect to each of those tax buckets. And there are some asset classes that you'll want to put in certain tax buckets to get the biggest advantage on the tax side. And when you combine this idea of housing certain kinds of asset classes because of the tax consequences that they would otherwise generate in a taxable account, if you can be savvy about positioning those in the right tax buckets, wow, you'll be able to get a big edge against in the long term against the taxes that you would otherwise pay. So we want to help you start today, at least, with a high level overview of what the matchups are between these different asset classes and these tax buckets, and with that, then sort of set the table for a future podcast episode in which we really drill down and show how powerful this concept can be when we apply it to a few scenarios of specific hypothetical clients.
Yeah, so and I'm just going to summarize that a little bit. What most people will do is they'll think about their investments, as Erik was saying, from an asset allocation perspective. To overly simplify, what do I have in bonds versus stocks versus cash? And what Erik is saying is take it a step further and think about the tax treatment of your investment accounts, and then strategically select what investment goes where. So today we'll give you an overview of the account types and the tax treatment and how you should be thinking about it. And in the future, we'll show you with a hypothetical scenario what the actual impact is. For those of you that listen every week, you'll remember us getting into a heated debate a few weeks ago about potential Roth conversion and whether it makes sense or not. And I think that really got us going down this path. So we'll come back to that, and the impact of this tax allocation that we're discussing today will definitely be shown there.
Yeah, that's a great start. And just to kind of help our listeners out, either one of you could answer this. When we're going to be talking about the topic today, I'm sure some listeners are going to ask, is this too late for me? What are kind of the pros and cons, or all my assets are spread out across various accounts. I haven't really thought about it. Would it be too much to implement that change? What would be kind of your response to that, to kind of maybe jumpstart this or get people to really start looking at it or to consider this route?
If you pay taxes, it's not too late. Would
Agreed.
you agree with that? Yeah,
Completely.
So, yeah.
Yeah,
So
it
I
looks like
think-
the earlier you start too can make a really big difference in your financial plan too. What do you think about that, Eric?
Well, I certainly agree with that, because the advantage over time to not dissipating away your portfolio on unnecessary taxes is a powerful compounding element. And I would also say it's so far we've emphasized the tax behavior of different things that can go in your portfolio, but it's not just the tax behavior, it's also the growth behavior. And so those two combined are what guide the broad principles about where to put things.
Yeah, and then Roshan, you mentioned if you pay taxes, then it's not too late. Then you're assuming then that means everybody's doing it. Do you see cases where there's more people doing it than not, or is it the other way around?
Well, I think everyone should do it. I would guess the vast majority do not, at least from what I see. We definitely think about it when we're building portfolios for our clients, how to be tax efficient. But I have not really had many people come in with the tax efficient portfolio already set up. So from that experience, I would say I don't know that anyone is really thinking about that. At least that's doing it on their own.
Yeah, and hopefully when we go over like the numbers and kind of talk about this, and that's where we'll show that this should be something you should really consider or begin to have the conversation or look into. So that's a really great way to open it up, guys.
For sure.
so
And as we were preparing, I'm sorry to interrupt, but as we were preparing for this, Eric, you had said that you thought this may be the most valuable, if not one of the most valuable episodes that we have in terms of things people can implement and can have a real impact on their life.
Right. I was just reflecting on the toolkit, listeners, that we have been providing you with in terms of the Roth conversion conversation, the retirement withdrawal strategy conversation, the previous conversation that we've had about asset allocation, broadly speaking, the Social Security claiming strategy, and now coupled with the tax allocation question. The power of these, the synergies between these different concepts, is really what can really move the needle on the spendable portion of your portfolio. So, in fact, I would just want to come back to one of the things you just said, Roshan. That is, when you have clients or prospective clients that are saying, "Hey, you know what? I'm thinking about a move. I'd like to have a conversation with you. Here's my statements from my existing advisor," and you look at them. Do you normally see a difference between, let's say, the composition of their Roth, the composition of their IRA, the composition of their taxable account?
No, I typically see that it's the same thing across the board.
Yeah, and you're kind of sitting there scratching your head saying, okay, if you're in a low marginal income tax bracket, it's less consequential. But if you're in a high net worth, if you're a high net worth person and you're in a high marginal income tax bracket, the impact for you is, magnified. Let's just put it that way.
Yes, yeah, for sure. It definitely is. And as you say this, I think about this as well, and the type of investor, and I think sometimes, and tell me if you feel similar, but if you separate these things out, you really have to look at your portfolio as a whole, right? Because you might say, hey, well, this year, why did my taxable account do better than my Roth, or why did my Roth do better than my traditional? You really got to look at your portfolio as a whole. And I think that's something that people sometimes struggle with, right? Knowing that it's all part of a bigger puzzle as opposed to each account being different. And I think wrapping your head around that concept from a behavioral finance perspective is important, because the natural reaction would be, hey, Eric, my traditional did the best this year. Why don't we have all of our investments in the same thing the traditional IRA is in? Right. Or next year it's the Roth or the taxable, and so on and so forth. And so you've really got to look at it as a whole. And I think our responsibility in that case is we've really got to do a good job of explaining the whole concept and how it works, to our clients so they feel comfortable with it, not only up front, because usually I find that up front most people will say, oh yeah, that makes sense, let's do it. But you've also got to make sure on a year-over-year basis, when you have differences in performance, that they're comfortable with it as well.
I agree with that.
Let's start with the definitions and what the different buckets are. And we can also talk about what you should look at investing where. So I'm going to start with the easiest of the three, which is the taxable bucket. That's your regular investment account. And what we're talking about is the investment account, but your savings account, if you get interest on your checking account, you're lucky in this environment, but if you do, that counts as well. CDs, you get a 1099 at the end of the year, and you've got to put that, give that to your accountant or put that into whatever tax software you use, and you pay taxes on that every year. So the term taxable account is because you're paying taxes on it every single year, and that is one of the buckets. So I'm going to pose the question to both of you: what is the most tax efficient way to invest in a taxable account?
Well, I've got some thoughts about that, but Adrian, if you want to launch into that subject, I guess you can go first.
A broad one would just be how you structure it. I think that's just like the overall thing we'll be touching on. But you can go ahead, Eric.
Okay, so Will, this is a great question. So I would say, generally speaking, the worst choice is going to be something that will depend on what current tax law is doing with that particular, the fruit of that particular investment. And current tax law penalizes, or at least we can frame it as penalties or rewards, but it currently penalizes interest from bonds, and it penalizes short-term capital gains. Those two are treated as ordinary income and are taxed at that rate, whereas dividends and long-term capital gains are taxed at a lower rate, a preferential rate, which depends on your marginal income tax bracket, what that preferential rate is, but it's lower.
Yeah, and I just wanted to make sure before we move too far from your answer that we do specify that municipal bonds are tax favored. Those are bonds typically issued by municipalities, the state and local governments. When Erik says bonds, he definitely means everything except municipal bonds, right?
Right.
Yeah. So, but those, and that's a good way to put it, right? So, and I'm going to give you another question on this. So, if you get penalized for short-term capital gains and for taxable bonds in your taxable account, you should consider, ideally, once again, everyone doesn't have a perfect split between their portfolio. So what you should consider, though, is in an ideal case, just keep those assets out of your taxable account then, and you have them in either tax-free or tax-deferred. So, and this going over taxable, that's how we want you thinking about it. What goes where from either from the perspective of what's tax efficient, or as Erik put it, what causes you to have the greatest tax disadvantage in these accounts. So let's move on now.
Well, before you move on, so we've highlighted the things you want to avoid, but then let's highlight actually some of the things that you might want to include.
Oh, I thought you did when you mentioned dividends and long-term capital gains.
Oh, okay. Well, I just touched upon that quickly. So I would say, from that standpoint, I would say stocks. And I'm not now, I mean specifically stocks themselves rather than necessarily stock mutual funds. And because they're designed with an extra degree of tax efficiency, I would prefer, all else being equal, that's an important provision, all else being equal. And most often in the real life, it isn't the case that all else is equal. But for this purpose, at least, all else being equal, I would prefer ETFs to mutual funds.
Oh, so let's explain this. This is a very important point. So let's start with stocks versus mutual funds, right? Just because the ETFs are a little more tax efficient, but when you're investing in a stock, you as the investor control when you sell. So you can make sure you've held it for more than a year to get long-term capital gains treatment. When you're investing in a mutual fund, you as the investor don't determine when you sell the investments within the fund manager does. So they can sell things that are short-term or long-term, and it impacts your tax bill. So when Erik talks about stocks versus mutual funds, that's what he's referring to. And ETFs, I'm going to say, kind of fit in between, in the sense that they are more tax efficient than mutual fund, but not as tax efficient as individual stocks.
Yeah, the rules that the designers and creators of the ETF structure were able to win in the regulatory process are just incredible. So they're able to do swaps when they're trying to do, exit a position and enter a different one rather than an outright sale. That's one element of it. The other element of it is that in a mutual fund structure, if someone else wants to go buy a boat or a house and sells their mutual fund, while on the one hand they'll pay the capital gains tax, or assuming that they had a capital gain in their position, they hang everyone else in the fund with the consequence of their decision to sell, because the fund managers had to sell positions to create the cash to hand back to those departing shareholders. And so that creates a tax consequence for all of the remaining shareholders. Whereas in an ETF, you can use essentially a process to synthesize these ETFs or dissolve them, as the case may be, if that is necessary to satisfy supply and demand.
And that's where the tax efficiency comes into play with the ETFs. When Erik first mentioned the swap, that's a way to quote unquote exit a position, but you haven't, from a taxable perspective, exited the position. So that's a way to make it be treated as if it's a long-term gain, where in fact it might not have been.
Right. So stocks and ETFs would be, all else being equal, my preference. That is to stocks, and I will emphasize in this, when I said ETFs, I want to emphasize equity ETFs as opposed to taxable bond ETFs.
Bond ETFs, yeah. Good, great point. So summarizing with the taxable account, we want to try to avoid interest and short-term capital gains. We want to have dividends and long-term capital gains in there. Mm-hmm. So if you're structuring your portfolio and you try to weigh as much as you can of the things that would be long-term capital gains, more the individual stocks and the equity ETFs, and the dividends, which would also be, the individual stocks or equity ETFs. If we're trying to focus on that in the taxable account, well, where did the short-term capital gain pieces, the income pieces go? They would go either in tax-deferred or tax-free. So tax-deferred is similar to your 401k, 403b, TSP. You've gotten a tax deduction right now when you've put your money in most cases. There are some exceptions. You get a tax deduction today. You put your money in that account. You are not getting a 1099 every year. So you're not paying taxes on an annual basis in this account. But when you take it out, you'll pay ordinary income tax. And once again, comparing to what we discussed earlier, ordinary income tax is usually at a higher rate than the long-term capital gain, which once again, we'd like in your taxable account. So tax-deferred money goes in, typically pre-tax. It grows tax-deferred, and then when you take it out, it's taxable as ordinary income. So Erik, in structuring this portfolio, what do you want in the tax-deferred account?
Well, I would say that's the perfect place to put all those really tax inefficient things. So mutual funds are a fine choice in there, because they're the consequences that I described earlier that stem from the decisions of other shareholders to sell their positions that then lead to year-end capital gains distributions, both short and long-term capital gain distributions. Those are inconsequential to you from a tax standpoint inside the tax-deferred account. I'll use IRA or 401k as an example. So I look at that as a great choice within that framework, and particularly on the if I have a third bucket, which is a tax-free bucket. Now I'm going to go one step further, and I'm going to make a distinction between what I put in the tax-free bucket and what I put in the tax-deferred bucket. And I think just common sense tells us if I've got a choice between where I would locate the fastest growing things available to me, am I going to put those in the tax-free category or the one where I'll have to pay taxes on every single penny that comes out of that account? Gentlemen?
Tax-free all the way, right? You want the biggest growth in the tax-free, so you have more money, theoretically, that you don't pay tax on.
Yeah, I agree with Roshan there. And I'm trying to put my self in the listener's shoes on this episode. And I just imagine them like looking at their portfolios, looking at all their accounts, listening to what you and Roshan are saying today and say, wow, I have my mutual funds in my taxable account. I have my bonds over here. Like, it seems that whatever Roshan and Erik said should be in this account, I tend to have the opposite. So what should I do? What are the consequences if I'm switching or selling right now? I feel like all these questions might be loading up for our listeners. What would be your kind of first response? Granted, knowing that everyone's on a case-by-case, their own individual standpoint.
Well, my first answer to that is you don't just drop and sell everything and switch. This is not in particular when I'm thinking about the taxable account, just because if you're going to drop everything and switch, you might have created a worse tax bill than the money you'd be saving later by planning it. So from a taxable account perspective, you can't just drop and switch things around. So you really need to do it strategically. If you take out the taxable, you have a little more flexibility to just sort of change everything at one time and not worry about the taxes. But you've just got to consider the balances in each account as a percentage of your portfolio. So hypothetically speaking, if you want your portfolio to be half stocks and half bonds, and we're discussing having all the fastest growing accounts, investments in your Roth, and your Roth is only 10% of your overall portfolio, well, you can't have half your stocks in the Roth because it's only 10% of your portfolio. So you've got to make sure you've got to consider each account size, each investment type that you want in the accounts, what percentage of those investments you want in your portfolio, and then you've got to then put the puzzle together.
Yeah, and it's for that reason, because as you pointed out, for most people, I would say you look at the tax-free segment of their overall portfolio, it's the most restrictive. It's usually the smallest portion of the overall portfolio, which I think, because of the opportunity that a tax-free account presents for really loading up on the fastest growing things, that seems to me to be a very strong argument for really looking hard each and every year at either contributing to a Roth or doing a conversion. I'm not saying it is appropriate for everybody each and every year, but it's certainly worth looking at as to whether that there's this, each and every year, is this the opportunity? Does this year present the opportunity to really grow that portion of my portfolio?
Yeah, and I don't think we actually said this explicitly. I think we might sometimes take it for granted on our end, but in that tax-free area, the common things people typically have, because there are some others, but is the Roth IRA and then the municipal bonds we talked about before. Those tend to be the common ones. Erik, tell me if there are others that you see as common. I just don't want to go too deep into the more complicated versions that are out there.
Yeah, well, I won't go into the really complicated ones, but I would say the Roth component of a 401k is also an innovation of the last decade or so that is often overlooked by people.
Yeah, what Erik's talking about when he says component is the Roth 401k tends to be an option for most people now that was not available typically 10 years ago.
And if you're in a situation where your income is too high to contribute to a Roth IRA, if your 401k offers that Roth component, there is not an income test that specifies whether you may or you may not. So generally, by the way, since we have a lot of younger listeners, then I would say you are in the best position. You have the most, what would I say, lead time for really making full use of the decision to make contributions to a Roth. So if you can get after it when you're younger and get that thing built, get started on building that sooner, go for it.
Yeah. That being said, I also want to just put the statement out there that consider your tax bracket too when you're making those contributions.
True.
Don't, just like we said, don't drop and switch your portfolio tomorrow. Don't log in, I should say, to your human resources account and change everything to a Roth IRA, Roth 401k, contributions tomorrow. Mm-hmm. You definitely want to look at your tax bracket. But Erik's point is definitely stands there. For people that are closer to retirement age or have closer to retirement age, they likely have a lot less a portion of their retirement in the Roth, whereas people who are who've got 20 or 30 years left to save, well, you can make that Roth 401k pretty big, and you may be able to put yourself in a portfolio where you've got an equal amount in the Roth bucket, whether it's IRA or 401k, that as you do in the taxable bucket, which you go back a few years and that just wasn't possible. So
right. So go ahead.
Oh, I was just going to take us back to the three categories and what we need to have in there. But Erik, please add what you have to first.
Oh, I was just going to summarize. So I would say, if in a perfect world you have capacity in your Roth component to put your racehorse, fast-growing, tax-inefficient things, in your IRA to put your other tax-inefficient things, and then finally in your taxable account, your tax-efficient growing things. And that's basically the rule of thumb that I would use. It's not a universal application, but as a general rule of thumb, that's how I would put it. So the fast-growing in the Roth, the worst tax offenders in your tax-deferred, and then your tax-efficient growers in your taxable account.
Yep. And so going back through that list, the taxable account, the tax-efficient growers tend to be individual stocks because that's where you'll get the dividends and that's where you'll get the long-term capital gains treatment. Then in your tax-free, you want the fastest growing piece. There may be a little bit of a conflict here because individual stocks typically are going to be your faster growing pieces of the portfolio, but that's where you've got to weigh what percentage of your assets do you have in a Roth versus taxable and what goes where, and you sort of just pick what goes where, knowing that the asset allocation and your risk tolerance takes priority, right? Don't just put more money in stocks because it's tax efficient, only if that fits your risk tolerance and your asset allocation for your portfolio. And then essentially what's left, you had said, goes into the tax-deferred, which are the IRAs and 401ks. But what's really left in this case would be things that would have short-term capital gains. So sometimes you've got the mutual funds with high turnover or things that are trading a lot. And then you've got things that pay income like those taxable bonds in various types of taxable bonds. So that's the starting point, right? So taking a step back again, first, look at your portfolio overall and your risk tolerance. Then you look at, from your overall portfolio, what percentage should you have in these different areas, the bonds, the stocks, mutual funds, and so on. And then you say, well, what percentage of my portfolio is a Roth traditional, Roth IRA in the tax-free or 401k, the tax-deferred bucket, versus taxable bucket, and then you sort of have to connect the dots. So it's not as easy as having the same portfolio in every account, which is what we tend to see.
Right. So if you are thinking, "Oh my goodness, what a mess I have," so we would encourage you to get with an advisor who has an eye for this sort of thing, who has done this sort of thing and thought this thing through with other clients and is in a position to really help you do this in a sort of rational way, looking at all of the tax consequences for you, as well as as Roshan has said, the risk elements for you. And if they're not giving sort of any indications that that's even on their radar screen, I would probably say, the higher your tax bracket, the more you want to be thinking twice about really using that advisor for that part of your decision-making process.
Yeah, and Eric, actually, the tax bracket, the higher tax bracket might be the greater consequence now.
Mm-hmm.
But your asset level or your income level, if you're in the lower tax bracket, it's just as important, because at the end of the day, regardless of tax bracket, you need your money to last your lifetime, right?
Sure.
So
yes,
anything you can save in taxes is money that's in your pocket, so it just lasts longer.
Right. Here.
So I would go back. I don't
wait.
disagree with you saying more important for the higher tax bracket because you're paying more in taxes.
Mm-hmm.
Yes, but I definitely think this is something that, as we said at the beginning, when Adrian said, "Is it too late?" and my response was, "If you're paying any taxes, you should be looking into this." I stand by that. Any tax rate, any tax bracket, look into this.
Yeah. Well, listen, listeners, I just want to say, as a preview of coming fireworks, man, we are going to light it up in one of our upcoming episodes, where we take these broad principles and apply them to some specific client cases. I cannot wait.
Yep, we will definitely have that coming up for you, and it's interesting because it'll show how everyone's situation is different, and it goes beyond the numbers also into what you feel personally. So I think it'll be a lot of fun. We wanted to split it up just because if we combine the two, it'd probably be a 2-hour episode.
Mm-hmm.
But remember, for today, we went over the definition of the tax accounts and what we would like to add into each account from a tax efficiency perspective. Gentlemen, do you have anything that you'd like to add in closing?
I'm all set, but I look forward to some more future debates between you and Eric on these topics. It makes me think that maybe one episode I should wear like a referee outfit and have like a whistle, have some rules set in place so it's at least organized.
Well, so we should just let our listeners in on a little secret. So just before we hit the record button today, we were going back and forth. We had a giant argument, and so we were thinking we should have just recorded this big argument, and then we thought, no, let's give the primer first, and then we'll follow up and build on that foundation with digging into it. So I think we're primed and ready for a real showdown.
Yes, we have that coming in our next episode for you, and thank you for joining us again. We hope you find this helpful, and these are things for you to think about, possibly implement yourself. As Eric said, some of this stuff you'll need help with. We are definitely here to help as well. Most recently, we did an episode from one of our listeners, Neil, recommended on options. So if you've got questions, want to go deeper on here, or have an episode suggestion related to this or completely not, please let us know. All of our information to contact us are in the description and the show notes. Please like, subscribe, give us 5 stars, tell your friends, and thank you for listening again. This has been another episode of the Retirement Lifestyle Show.